We are waiting, a little bit delayed, but we're waiting to hear from the Chancellor, Rachel Reeves, and then after that from the Governor of the Bank of England, Andrew Bailey. They're about to make speeches about the economy at Mansion House in the City of London. So these are the live pictures we have. It is a very splendid, formal affair. The camera is just lining up there. You can see the microphones ready. We are expecting to see Rachel Reeves come to those microphones. When she does, we will stop talking. But Faisal, just talk us through the setup here, what this event is and what it's all about.
Mansion House is one of the key fixtures in the British financial calendar. It's a moment where, as I said, the Chancellor and the Bank of England Governor can set out more strategic thinking. They can capture, command, if you like, the confidence of very senior financiers. You can hear the clapping here. It's all done in the august surroundings and the pomp and ceremony of the...
Faisal, on pomp and ceremony, we'll just interrupt you because as the applause dies down, let's listen in to the Chancellor,
Lord Mayor,
Rachel Reeves.
Governor, ladies and gentlemen, it's an honour to be here with you this evening. Thank you to the City of London Corporation for hosting us, and it's a privilege to follow the Lord Mayor's address and to give my first Mansion House speech. As the Lord Mayor said, there are so many reasons to be optimistic about our country, and I absolutely share his ambition for our potential. The potential of our financial services sector, the potential we have to make Britain more competitive, and critically, the potential that we have to grow our economy. That is why, both in opposition and now in government, improving economic growth has been at the very heart of everything that I am seeking to achieve. In my May's lecture earlier this year, I set out my view that we are in a moment of flux, and a new approach was required to build secure and sustainable growth on the platform of stability, investment and reform. When I arrived at the Treasury just over 4 months ago, I said on day one that economic growth was now our national mission, as I set out plans to tackle some of the long-standing issues in the supply side of our economy. And 2 weeks ago, I delivered my first budget as Chancellor of the Exchequer. It was a once-in-a-Parliament budget to wipe the slate clean. It was a budget that tackled two elements in our plan for economic growth. First, it provided economic stability by putting our public finances back on a firm footing. That required difficult choices on spending, on welfare, and on tax. But by making those tough choices now, we are providing stability for the long term. Because instability in our public finances leads to instability in our financial markets. That is not good for investment, that is not good for growth, and it is not good for business. So by drawing a line under instability, business can now plan for the future. And we have provided stability for our public services too, which must now deliver within the spending envelope that they have been set. And through reform, they must live within their means. The second step that we took to improve economic growth at the budget was to change course on public investment. Public investment was set to fall by nearly 1% of GDP under the plans that I inherited. That would have held back our growth potential for many years to come. As the International Monetary Funds have set out, low levels of public investment have been a major contributing factor to the UK's weak growth performance, not least because it makes it harder to catalyse the private investment that we so badly need. Now, as a result of the measures that we have taken, public investment will be £100 billion higher over the next 5 years, creating jobs and driving growth and opportunity across the United Kingdom. This will be delivered alongside a series of vital guardrails to ensure that spending delivers the very best value for money, provides returns for taxpayers, catalyses private investment, and significantly boosts growth and productivity. Because of the steps that we took, the Office of Budget Responsibility have set out that in the long term, our policies would permanently increase the supply capacity of the economy. But that does not represent the height of my ambition. I know that we can do more, to go further and faster in realising our growth potential. So that is why economic growth will continue to be the central mission in the weeks, months and years ahead. Having focused on economic stability and public investment in the budget, tonight I will set out the steps that we are taking to drive growth across the other key areas that have long been my priority: increasing private investment and reforming our economy. Let me begin with our plans to increase investment. More investment is how we spur innovation and growth. It is how we boost the efficiency and the capacity of our economy. And it is how we create the new opportunities and high-skilled jobs in every part of our country. Today I am focusing on how we continue to attract investment across the world and how we increase private investment by working in partnership with business, and specifically with the financial services sector. Before entering politics, I worked as an economist at the Bank of England and then in financial services. Before we came into government, I was clear that financial services must play a central part in our economic vision and our plans for economic growth, because I know that this sector is the crown jewel in our economy. It employs 1.2 million people, from London to Edinburgh and from Manchester to Belfast. It is one of the country's largest and most productive sectors, accounting for 9% of our economic output. And it is a global success story, as the Lord Mayor has said. We are the second largest exporter of financial services in the G7. But we cannot take the UK's status as a global financial centre for granted. In a highly competitive world, we need to earn that status, and we need to work to keep it. I have been determined to do just that since becoming Chancellor. Just 1 week into office, I welcomed the biggest changes to the UK's listing regime in over 3 decades, to reform our capital markets, increasing the flexibility of firms and founders of British high-growth companies. So we have more British success stories, like Raspberry Pi and Applied Nutrition, IPO'd right here in the UK. In our first month, we launched the landmark pensions review, and I will return to that later in my speech. And in September, we announced the final stage of our post-crisis reforms to banks' capital requirements, marking the end of the journey to ensure that banks are well capitalised, working side by side with the Governor, strengthening our resilience of our banking system, whilst protecting banks' ability to lend to small and medium enterprises and also for infrastructure. Now we must build on the steps that we've already taken. In the spring, we will publish the first ever Financial Services Growth and Competitiveness Strategy. This will give the financial services sector the confidence it needs to invest. Financial services is one of the 8 growth sectors in our modern industrial strategy, recognising that, just as in other parts of the economy, we must constantly work to remove barriers to growth and investment. This approach will ensure that we promote our strengths across the world. And today, we are setting out the 5 priority growth opportunities on which that strategy will focus: fintech, sustainable finance, asset management and wholesale services, insurance and reinsurance, and capital markets. And we will work in partnership with you on the development of the strategy, ahead of its publication in the spring, driven forward by our City Minister, Tulip Siddiq. By providing the basis of long-term stability for the sector, we are laying the foundations for more private investment. The UK has the lowest levels of business investment in the G7 as a percentage of GDP. In the budget, we confirmed our plans to capitalise the flagship impact investor, the National Wealth Fund, to invest in the industries of the future and catalyse over £70 billion of private investment. And in the last month alone, the National Wealth Fund has struck a number of deals, including funding to deliver full fibre broadband across the UK and support the building of vital new infrastructure in Wales. The PRA, the Treasury and the National Wealth Fund will work together to crowd in investment by insurers in productive assets, taking full advantage of the new Solvency UK regulatory regime. That includes investment in clean energy projects. I want London to be the place where the billions needed to finance the energy transition are financed. And we have already mobilised significant private capital through the International Investment Summit last month, including £4 billion for the East Anglia 2 wind farm and £2 billion to build new solar farms in Essex, Yorkshire and Wiltshire. This week, the Prime Minister welcomed the launch of the Climate Investment Fund capital market mechanism on the London Stock Exchange. Tonight, we are building on those foundations to deliver a world-leading sustainable finance framework. This will be built in partnership with industry, and we will be co-launching the Transition Finance Council alongside the City of London Corporation. This presents a huge opportunity for the UK financial services sector, and I am determined that we win this race for global business. Alongside our National Wealth Fund, we must ensure that there are a wide range of other vehicles to drive private investment. Tonight, I want to focus on our plan in one of those key areas: pension funds. Our pensions market is one of the largest in the world. There will be £800 billion of assets in workplace defined contribution schemes and £500 billion of assets in the local government pension scheme by the end of this decade. Pension funds will always play an important role in the gilt market. But for too long, pensions capital has not been used to support the development of British start-ups, scale-ups, or to meet our infrastructure needs. I have long been of the view that this hurts our economy because our highest potential businesses cannot expand, and savers are not seeing the returns on their investment which they deserve. So I was pleased when the previous government, led by my predecessor as Chancellor, working with industry, took steps through the Mansion House Compact to encourage more pension fund investment into productive assets. I welcomed those reforms, and we will take them forward. But now we need to go further. That is why one of my first steps as Chancellor was to announce the Pensions Investment Review, led by our first ever joint Treasury and DWP Minister for Pensions, Emma Reynolds, who has worked with many of you over recent months. Australian pension schemes invest around 3 times more in infrastructure investment compared to defined contribution schemes in the UK, and 10 times more in private equity, including in high-growth businesses compared to the UK. One of the key reasons for this is the much larger size of their funds, while our pensions landscape remains highly fragmented. That means many of our pension funds do not have the capacity to invest at the scale required. And more often than not, it is Canadian teachers and Australian professors reaping the rewards of investing in British productive assets through their pension schemes, rather than British savers. That's not good enough, and we need to change that. So tonight, we are publishing the interim report of the Pensions Investment Review. It sets out our plans to create Canadian and Australian-style mega funds to power growth in our economy and start the most significant set of changes to the pensions landscape since the Turner Review, underpinned by a clear commitment to legislate for these changes for the first time in the Pension Scheme Bill next year. We will deliver a significant consolidation of the defined contribution market to enable schemes to deliver better saver outcomes while investing to support growth. And we will legislate on measures to consolidate the local government pension scheme, one of the largest pension schemes in the world, and require that the 86 local government pension scheme administering authorities consolidate all of their assets into 8 pools. These reforms will deliver real change in our economy through consolidation of the DC market and the local government pension scheme into mega funds. Previous domestic and international experience suggests that we could unlock around £80 billion for investment in private equity, including exciting growth businesses, and in vital infrastructure projects, including transport, energy, and housing projects here in the UK. We will take a more proactive approach to working with investors to ensure that capital is directed to the UK's biggest growth opportunities. We are creating NISTA, and we will publish a 10-year infrastructure strategy to ensure that there is a pipeline of projects to attract that investment. We have established a new Pathfinder British Growth Partnership to crowd in institutional investment into venture capital funds and innovative businesses here in the UK. This work is already making an impact. I can confirm this evening that Aegon UK will be a substantial cornerstone investor, as well as NatWest Cushion, and they have now agreed to work with the British Business Bank on the launch of the British Growth Partnership, with a view to making an investment in the initial fund. The final area I want to focus on when it comes to investment is the importance of looking internationally. Last month, with the support of many people in this room, including the Lord Mayor and Barclays, HSBC, Lloyds and M&G, we hosted an international investment summit in London, where we saw £63 billion of investment flow into the UK. That shows the potential that we have to attract funding from across the world into our country. But I want to be clear-eyed about the context in which the UK and its businesses will be operating under in the years ahead. We face geopolitical uncertainty. There are other countries who are looking for the very same economic opportunities as we are. And we face structural challenges too, including those which have come from Brexit. It will not be straightforward to navigate all of these headwinds. We should be honest about that. But as we navigate them, I will be guided by a clear principle. I will always do what is in our national interest, for our economy, for our businesses, and for the British people. That means free and open trade, especially with our most economically important partners. That includes the United States, our single most important destination for financial services trade. And there is so much potential for us to deepen our economic relationship on areas such as emerging technologies. I look forward to working closely with President-elect Trump and his team to strengthen our relationship in the years ahead. And of course, our biggest trading partner is the European Union. We will not be reversing Brexit or re-entering the single market or customs union, but we must reset our relationship. That would be my message when I attend the Eurogroup meeting of finance ministers in Brussels next month. We must recognise that our markets are highly interconnected and ensure that on the economy and in financial services, our approach supports growth and delivers investment. And where there are other important economic opportunities for the UK, including by engaging with significant and fast-growing economies like India, China, and the Gulf states, we will look to realise those opportunities too. Alongside economic stability and higher levels of investment, we need reform. Supply-side reform has been a central part of our work in the last 4 months, through changes to our planning system to unlock housing and new infrastructure, policies to reduce economic inactivity, improve skills, and bring people back into the workplace, and a focus on place-based measures to deliver growth right across the UK. I know that the Governor will have more to say on the topic of supply-side reform shortly. Tonight, I want to build on the work that we have done, which puts reform at the heart of this government's agenda. First, I am clear that this must include reform of our public services. In the budget, I set out our future spending plans to ensure that our public services have the investment that they need for the years ahead. That additional investment comes with a clear expectation of better value for money and higher productivity. As the Secretary of State for Health said yesterday, taxpayers welcome the additional investment we put into the NHS, but they worry that it won't be spent wisely. So reform will be a central focus of the second phase of the spending review right across government. We will use digital technology more effectively. We will focus on prevention to manage pressures in the system. We will join up services across government to increase efficiency and to bring costs down. And we will harness the knowledge and expertise of business leaders as we do so, so that we can ensure that we bring the best ideas into government from beyond Whitehall too. Alongside this, we need economic reform to unlock the full growth potential of our economy. Our approach to regulation is a critical part of that. As the Prime Minister has already set out, the key test for regulation is whether it will make our economy more dynamic and more competitive. So we will review the strategic guidance that we give to the CMA and to other major regulators to underline the importance of growth. That includes our financial service regulators. It was right that successive governments made regulatory changes after the global financial crisis to ensure that regulation kept pace with the global economy of the time. But it is important that we learn the lessons of the past. These changes have resulted in a system which sought to eliminate risk-taking. That has gone too far. And in places, it has had unintended consequences that we must now address. Let me set out some examples. First, while the senior managers and certification regime has helped to improve standards and accountability, some elements of it have become overly costly and administratively burdensome. So the Treasury, the FCA and the PRA will shortly publish the outcomes of our review, including a commitment to consult on removing the current certification regime from legislation. Second, as the PRA have acknowledged, post-crisis pay structures made the UK an international outlier on deferral arrangements. So, we will support their intention to consult on reducing the length of pay deferrals, helping firms to attract and retain talent. Third, some of our regulatory requirements are duplicative, and they could be streamlined. So I look forward to seeing the outcomes of the FCA's handbook review, which can free up resources for businesses to innovate and to grow. And finally, while regulation has been successful in improving the quality of financial advice being offered to consumers, many people do not get the help with their finances that they want and need. So the FCA will shortly consult on transformational changes to financial advice and guidance to ensure that people get the right support. As these examples show, the UK has been regulating for risk, but not regulating for growth. So while maintaining important consumer protections, upholding international standards of regulation, and protecting the vital stability of our financial services system, now is also the moment to rebalance our approach and take forward the next stage of reforms needed to drive growth, competitiveness, and investment. The last government introduced legislation to make growth and competitiveness secondary objectives for our regulators, which we supported in opposition. Tonight, I can announce that we have issued new growth-focused remit letters to the Financial Conduct Authority, Prudential Regulation Committee, Monetary Policy Committee, Financial Policy Committee, and the Payment System Regulator. These make clear that I expect them to fully support this government's ambitions on economic growth. I welcome the work that the FCA and the PRA have already started, and I look forward to seeing their next steps to deliver that growth and competitiveness. I have also heard from many of you that our approach to redress can cause uncertainty and be a drag on investment. The Financial Ombudsman Service plays a vital role for consumers to get redress when things have gone wrong, and that will not change. But reform is needed to create a surer climate for investment. So we have worked closely with the FCA and the Ombudsman to develop a new agreement between the two institutions, with clearer expectations on how they cooperate, including on historic market practice and mass redress events. And I strongly welcome their joint call for input to be published tomorrow, which seeks to significantly improve the rules governing how the service operates. Alongside these measures, we are tonight setting out a range of further steps to build a true partnership between government and the financial services sector and unlock its potential. Let me take you through them. Because reforming capital markets is a priority for this government, we are today committing to legislate to establish PICES, an innovative new stock market, by May 2025 to support companies to scale and grow. We are supporting innovation in the financial services sector by launching a pilot to deliver a digital gilt instrument, referred to as Digit, using distributed ledger technology. Insurance markets are also pivotal in supporting growth. So, we are today publishing a consultation on captive insurance, where a new approach could cement the UK's position as a leading financial services centre. And alongside the regulators' continued efforts, we will consider further steps to improve the UK's insurance-linked securities offer. To protect the integrity of the financial services sector, we are working with tech platforms and telco networks to reduce the scale of incidents and losses from fraud. To empower female entrepreneurs and support women in business, we are backing the ambitious work of the Invest in Women Task Force, led by Debbie Wasco and Hannah Bernard, delivered alongside our Women in Finance Charter, led by Dame Amanda Blank, which continues to go from strength to strength. To support the mutual sector, we are launching a call for evidence on the credit union common bond and asking regulators to report on the mutuals landscape. And I welcome the work of Nationwide, Cooperative Group, Arla and Royal London to establish an industry-led mutuals council to drive growth in the sector. And finally, we are publishing our national payments vision, including decisive action to progress open banking and support our fintech businesses. Lord Mayor, Governors, ladies and gentlemen, in the budget 2 weeks ago, we fixed the foundations and restored stability to our public finances, the precondition for a strong and successful economy. The changes that I have set out this evening will drive growth and competitiveness through investment and reform. A long-term strategy to harness the strengths of our financial services sector, making the UK a global leader in sustainable finance, reducing uncertainty by developing the right approach to redress, reinvigorating our capital markets by unlocking private investment through our pension funds, and reforming our approach to regulation to make it more dynamic and the sector more competitive. Taken together, these measures represent the most pro-growth financial services package since the financial crisis, because we cannot rest on our laurels. Where we have strengths, we must build on them. Where we have weaknesses, we must address them. And in everything we do, we will work together, with you, in partnership, because that is what our country needs to prosper and to grow. Thank you very much.
That was Rachel Reeves there, the Chancellor, delivering her first Mansion House speech in front of the great and the good there in the City of London. Plenty of business leaders there will be picking through her words. She finished that speech basically in the way she started, talking about the budget that she delivered a couple of weeks ago and defending it as a growth budget. No specific mention of those tax rises on businesses, which you'd imagine some people there perhaps not so keen on. But she made her argument, laying out that it provided stability and it changed course on public investment. And now we are hearing from Andrew Bailey, Governor of the Bank of England, to deliver his speech now for the next few minutes. Let's listen.
My Lord Mayor, Lady Mayoress, Chancellor, Your Excellency, ladies and gentlemen. Well, Lord Mayor, congratulations on taking up the mayoralty, and I look forward to working closely with you over the next year. The timing of events this year means that you are at real risk of having the Chancellor and I descend on you twice during your term, which of course is a blessing. So I'm going to use my time this evening to talk about growth in the economy, why it matters, the current state of economic growth and its determinants, and what can happen in the future. Now, you've probably already got the message this evening. These are, of course, very important issues. So I'm going to start with a little bit of scene setting and context. Our decisions at the Bank of England on monetary policy require us to assess the consequences for inflation of the pressure at the given time on the resources of the domestic economy. And that pressure reflects the balance between demand and supply in goods and services and in the labour market. And we can't just look at actual output and employment and their growth. We have to compare those actuals with a measure of the potential of the economy, the productive potential of the economy to supply. This way we can assess the utilisation of resources, but we can't actually directly observe that productive potential. It has to be estimated, and from that we can produce an assessment of the degree of slack and spare capacity in the economy. Now, this is crucial for the MPC when we assess inflationary pressures in the economy. But of course, the overall significance of this goes much beyond that. Because as well as being the speed limit for how quickly the economy can grow without causing upward inflationary pressure, it also determines the growth of wealth in the long run and is critical in many aspects of public policy, including fiscal policy. So what determines that potential supply? Well, in the shorter term, it's the supply of labour and productivity, the efficiency of the use of the inputs. But in the medium to longer term, it's structural factors such as the population size, the rate of innovation, changes in education, changes in skills. So that's it for theorising, and I hope this much makes the point that growth in the economy matters. So the next question is, why does it matter now? And what's been going on? Now, there are almost, needless to say, lots of facts and figures that could be put forward at this stage. I'm going to stick to the bare minimum. And the bottom line, I'm afraid, is it isn't a very good story. So I'm going to give three figures for three time periods. The average annual rate of growth of potential supply in the UK economy, and the contribution to that growth rate of productivity and of labour supply. So from 1990 to 2008, the average annual potential growth rate was 2.6%. Productivity contributed 2.2 percentage points of that, and labour supply the other 0.4. After the financial crisis, from 2009 to 2019, that potential growth rate fell to 1.3% a year. Productivity contributed 0.3 percentage points, and the labour supply 1 percentage point. From 2020 to 2023, the potential growth rate fell further to 0.7%, with productivity contributing 0.5 percentage points and labour supply 0.2. COVID was clearly a major factor there. So that's it for the numbers. I think the point comes across. Potential supply growth has fallen since the financial crisis. The main contributor to that fall has been weaker productivity growth. COVID was then a major factor in causing a further fall. I think the issue now is not what COVID did at the time. It was clearly a huge shock to the economy. The more important question now is whether and to what extent COVID has left a lasting impact on potential supply. Now, I'm not going to spend the rest of my time seeking to diagnose what has happened to potential growth since the financial crisis. It's highly relevant, but time doesn't allow for that. But before moving to a series of questions designed to help to set out what we should do about the situation, there's at least one other big question which deserves a short answer at least. Is the UK alone in this situation? Well, not entirely. The UK looks rather more like other parts of Europe than this continent does relative to the US. The US has a better story to tell. So I'm going to frame the rest of my remarks around 5 questions which I think are relevant to thinking about what we do to tackle this issue of potential supply and growth in the economy. The answers will be short. A lot more could be said this evening, but not this evening, and I hope, Lord Mayor, you'll be pleased that I'm not going to take up the whole of the rest of the night. So the 5 questions are: why does investment matter and what can we do about it? Is the labour supply an issue? Are we measuring things properly? And if we did, could we rest easy? Does the openness of the economy and the world economy matter here? And finally, will AI ride to the rescue? So, why does investment in the economy matter and what can we do about it? Well, productivity growth is linked to capital deepening, so it's linked to investment. The OECD produces data which show investment as a share of GDP. I'm afraid the UK has almost continuously been at the bottom of the G7 league table since the late 1990s. So other things equal, the UK has a lower level of capital. And looking over the last 10 years, business investment in the UK has been particularly weak by G7 standards. So we do need to encourage business investment in the UK. Public investment is important as a foundation. We need better infrastructure and investment in education and health services. So, Chancellor, I welcome the plans you've set out in the budget and the focus you have placed on public capital investment. To those who have pointed out that this will not, using the OBR's projections, raise the potential growth rate substantially, my response to that is, well, of course it won't on its own. The OBR does project an increase in potential growth, but that needs to be accompanied by stronger business investment, just as you've set out this evening, Chancellor. And that business investment will depend on quite a few things, including good public infrastructure. The Lord Mayor kindly described me as a veteran earlier on. That's really good of you. Veteran of quite a few dinners at the Mansion House. And I say this because I well remember, Lord Mayor, a number of your predecessors exhorting the Chancellor of the day to build Crossrail, as it was then known. Well, it wasn't always easy, and it took rather more time and rather more money than was expected. But let's say this, we have the Elizabeth line now, and it's really good. So it is worth remembering this story about what we can do. The second big need for investment is the financial system being organised to supply capital. This has been a regular subject at these dinners, not least because, as you said, Lord Mayor, the tireless and continuous advocacy of Sir Nicholas Lyons. And pension issues are important here, as the Chancellor has said. The UK pension system is too fragmented in this respect. Chancellor, I want to thank you for the work that you and Emma Reynolds are leading here, and you have set out this evening your plans. It is, I'm afraid, heavy lifting, and a lot of it. But you will have and must have all of our support. And as I've said recently, as well as addressing fragmentation of pension funds, we have to encourage investment in the real economy. Requiring or trying to compel investment is not the answer, but saying that cannot take the issue off the table, far from it, as you have very rightly said. And as the Lord Mayor has said, the City has an important role to play here in working to help to solve this issue. So the next question is labour supply. Is it an issue? Yes. Because it is, along with productivity, the main determinant of potential supply in the economy and growth. In the medium to long term, the dominant influence here is likely to be the ageing population. The UK is very far, of course, from being alone in this respect. But there are shorter-term trends and determinants as well in terms of labour supply, and I will come on to these in a moment. But the ageing population does mean the tide is running against us in terms of labour supply. It makes the productivity and investment issue all the more important. And I will say this, that when we think about broad policy on labour supply, the economic arguments really must feature in that debate. So the third question is, are we measuring things properly and does it matter? Now, oh no, you're thinking at this point, he's going to go on about data again. Well, don't worry, I'm not. But we probably are not measuring things properly. To some degree, we never do and never can. But we can't fall back on the measurement issue and assume the thing away. There are three main areas of measurement, and all of them have issues: the overall size of the economy, the amount of investment, and the labour force. Now, the economy is actually probably bigger than we think it is. Why is that? Because we're not very good at measuring intangibles, and these are the new economy, after all. The ONS is going to include the value of data as an asset in the overall size of GDP in the next few years. And that makes sense, and it's probably worth a percentage or two on GDP, so don't turn it down. Likewise, on investment, we don't measure investment in intangibles very well, and this is the growth area, if you think about IT. But I'm afraid there's little reason to think this will vault the UK up the league table of investment. It will probably mean all boats get lifted a bit. Finally, there's the labour force. Oh dear. The travails of the labour force survey are now quite well known. It's a substantial problem, and not just for monetary policy, when we don't know how many people are participating in the economy. Now, it would help if across the country we were better at answering the phone when the ONS call up. I have to say, I do struggle when my fellow central bank governors ask me why the British are particularly bad at this. I don't have a very good answer to it. But the bank, alongside other users, including the Treasury, continue to engage with the ONS on efforts to tackle these problems and improve the quality of UK labour market data. So measurement is an issue, but it doesn't take away the need to raise potential supply and growth in the economy. Question 4. Does the openness of the economy matter for potential supply? Yes. Openness to trade in goods and services affects productivity by facilitating competition, innovation, and specialisation. There's a strong, positive relationship between openness to trade and foreign direct investment and productivity. And we can thank Adam Smith and David Ricardo for some of the earliest insights on this area. It's not new. Now, I've said many times as a public official, I take no position on Brexit per se, and that's very important. But I do have to point out consequences. The changing trading relationship with the EU has weighed on the level of potential supply. The impact on trade seems to be more in goods than services, which I don't think is particularly surprising. But it underlines why we must be alert to and welcome opportunities to rebuild relations while respecting that very important decision of the British people. But we shouldn't just focus on the effects of Brexit. The picture is now clouded by the impact of geopolitical shocks and broader fragmentation in the world economy. Now, I have to own up to being an old-fashioned free trader at heart. I think it's a British characteristic. I like to think it is. My point is this. Amidst the important need to be alert to the threats to economic security, let's please remember the importance of openness. It's an important determinant of productivity. So the last question. Will AI just ride to the rescue and solve the problem? Well, I'm not going to give another speech now on AI, you'll be pleased to hear, so this is going to be very brief. AI has the clear potential to become general-purpose technology. In other words, it can enable widespread innovation across many parts of the economy. Previous examples of general-purpose technology were the steam engine and electricity. Sadly, not long ago, the British economic historian Nick Crafts passed away. I knew Nick 40 years ago before I became a central banker. And one of the things Nick taught us was that general-purpose technologies take longer to spread into the economy and the productivity data than we think they will. It was nearly 40 years for electricity. I don't for a moment think it will be that long for AI, but Nick's point remains true. We're mostly experimenting with AI at the moment, and that's a good thing. There are strong grounds for optimism. And of course, there are risks with AI, but it isn't an immediate magic solution. It has lots of potential and we must stick with it. So to conclude, Lord Mayor, potential supply and growth matter a lot. We don't have a good recent inheritance, so it is a big issue and it needs our attention. Investment in capital formation and how to increase it matter. So does labour supply in the face of an ageing population and an immediate question of participation. We can and should measure things better, and we could try answering the phone when the ONS call up. We must do what we sensibly can to preserve safe openness of the economy. AI has a lot of potential to change the picture, but don't expect that change to come very quickly. That would not be the right assumption. But let me finish by saying these are very important issues for the growth of the economy and the well-being of our society. Now, when it comes to well-being, I have one thing left to say, and that's a toast. And it's a toast to the Lord Mayor and the Lady Mayoress. Lord Mayor, Lady Mayoress.
And so on that round of applause, we will leave Mansion House there in the city as Andrew Bailey, Governor of the Bank of England, wrapped up his speech talking about growth, describing it, in his words, it isn't a very good story. He touched on Brexit and the challenges that posed to growth, labour supply challenges, AI opportunities, problems of measuring economic data better, and the importance of keeping the economy open.